Hi there, and welcome to The Open on BNN Bloomberg. I'm Lindsay Biscaya, filling in for Andrew Bell today. And now let's get to some of the stories we're following in the BNN Bloomberg newsroom for you. Canada's economy stalled in November with GDP flat month over month and falling below expectations. The drag came from goods-producing industries, which fell 0.3%, marking the third decline in 4 months. Manufacturing, agriculture and forestry, fishing and hunting were negative contributors to the reading. U.S. President Donald Trump says he intends to nominate Kevin Warsh as the next chair for the Federal Reserve. Warsh has previously served on the Board of Governors from 2006 to 2011 and was also an economic advisor for the president. Warsh was passed up for this position by Jerome Powell back in 2017. And Canadian National Railway beat estimates in both revenue and profit in the fourth quarter following the results. The company's board approved a 3% increase to its dividend. The board also approved a plan to buy back up to 24 million of its shares. The company says its shipping volumes will remain, quote, flattish for 2026 as it expects to spend roughly $2.8 billion in capital expenditures. And we'll take a look at the futures this morning before the bell. U.S. futures all trading down at the moment. We'll continue to watch that today. A lot of news coming out of the U.S. and the White House today, of course. If we look at the price of oil, we've seen that retreating slightly after a 3-day rally. At this point, it's up by about 0.2% this morning. Gold, also going to be talking about the price of gold and silver a lot today. Gold suffering its biggest swing in years, dropping as much as 8%. And if we take a look at the loonie this morning, it is down. This comes after we got some numbers at 8:30, the GDP numbers, which are unchanged month over month, and we'll be digging into that as well. We are watching shares of Apple today down at the moment before the bell. Now, the company posted record quarterly sales and better than expected guidance. However, investors are concerned about rising memory prices. Our next guest says Apple's results show consumer spending is holding up surprisingly well. Joining us now is Lauren Steiberg, president at Lauren Steiberg Wealth Management. It's good to have you in studio.
Great to be here. Thank you so much.
So you say consumer spending holding up well, despite what's interesting with these Apple results is the fact that there is going to be higher prices coming soon. I'm not sure if
Sure. And first of all, one of the interesting things is the average selling price was up significantly, which tells you that consumers are still able to keep on spending and buying more expensive iPhones. And that augurs, it's really a sign that consumer spending is pretty strong. And the Fed statement the other day also indicated that they're seeing a healthy consumer. Unemployment is relatively stable. So we're pretty bullish on those statistics.
You say it's surprising, though, right, that consumer spending is still strong, despite what we're going through right now. Why do you feel like it's so surprising?
I think it's some surprising given some of the negative news we're seeing. We're seeing softness in the auto sector and some other large manufacturing areas. Employment growth has been, somewhat weak. Unemployment up somewhat. Those are usually times when you see consumers pulling back somewhat, but we're seeing really healthy earnings from the consumer products and related companies.
Is there any other big earnings takeaways from Apple? I know Visa reported as well yesterday. Is there anything that stands out to you in terms of what you're talking about, like consumer spending?
Sure, a couple of things. And American Express reported this morning as well. And I'll tell you, one of the big things that we see there is that card spending is up in general, 8 or 9%. But also that bad debts have not risen very much. So the fact, usually bad debt increases is a sign that things are going to be softening. But to see big increases in card spending, both from Visa and from American Express, as well as strong earnings from companies like Apple and even Starbucks, is an indication that consumers are in a pretty good place.
We've seen, of course, rates both here in Canada and in the U.S. expected to hold steady, at least for a little longer. How does that factor into consumer spending, do you think, particularly with the Fed?
Well, I think the bigger indication is that the Fed not cutting rates because they're concerned from the other point of view that consumer spending is going to remain rather healthy and economic activity will be relatively robust. is an indication that, they see the data before anyone else does. And it looks pretty healthy. Also, I think from an investor standpoint, not cutting rates means there's dry powder available to cut rates later in the year if they do see a slowdown.
Okay, so let's move on a little bit. We're talking about a different sector now, and that's the software sector. And you were saying the software sell-off is overdue, and there's still some opportunities. Overdone, sorry.
Exactly. And one of the things, one of the reasons for this is fears of AI cutting into software sales and companies being able to do more. But there are a couple of phenomenal opportunities in the large cap sector. One of them is Adobe. And Adobe is a company that's been continuing to deliver double-digit revenue growth, double-digit earnings growth, big free cash flow generator. They are embedded in every major company's way of doing business on the IT side, and AI is helping them. Yet this company is trading at a paltry 13 times earnings.
Wow.
And is worth at least 50% more in our view. And we're forecasting continued earnings growth going forward this year.
Another one you're watching, Microsoft.
Microsoft, and we own both of these companies, let me say, and investors have an opportunity with Microsoft to buy one of the world's great businesses when it is on sale. Microsoft had blowout earnings of 15% plus revenue growth, 15% plus bottom line growth, and they are rolling out AI in a huge way, and Microsoft is at the nexus. Every major business in the world, Microsoft is their major IT vendor, and they are fully embedded in every company's IT infrastructure. And that should increase as more and more companies want to have one major company driving, one major vendor, because it makes it much easier for them. And so, investors have a chance on this pullback to buy Microsoft at about 30 times earnings, and we think the stock is worth significantly more.
It's interesting, right? When you're trying to navigate this whole AI world that we're moving into, the software sector, either people are very positive on it, like you, or saying, it's time to move on from the software sector. It's so hard to know which way to go.
It is, and so our focus is really on those companies that are must-haves if you're a large corporation. These are vendors you have to stick with, and you need an integrated solution. So we are less bullish on some of the smaller niche players who might end up losing market share, losing business. And actually, we expect Microsoft to gain market share from some of those smaller players that don't have the scale.
Just in our last minute or so, I did want to get to the price of gold and silver today as well, because it's so interesting what we're seeing, right? Do you think what we're seeing in this kind of drop in prices, is that a delayed response from the rate cuts that we saw earlier this week, or what do you think is going on there?
So one of these interesting, little facts that I've picked up on from the World Gold Council, which is not really surprising, is that a ton of money, almost $90 billion, came into inflows into gold ETFs in 2025, up wildly from a few $billion the previous year. And gold inflow and outflows into ETFs is really just momentum-based investors, driving things, overshooting on the upside or overshooting on the downside. Mm-hmm. So our view is that investors who have significant positions in gold should be paring those positions back at least. And there are better opportunities in so many other great businesses. So we're not bullish on gold from here.
Not bullish on gold. Okay. Thank you so much for coming in. That's all the time we have. Lauren Steinberg, appreciate your time. Thank you.
Thank you very much, Lindsay.
Thanks. Okay, coming up, we will look at what's driving Chevron and Exxon's lowest annual profits in years. More on that after the break. Chevron and Exxon reported its lowest annual profits in years, with Venezuela as a focal point. Here to dive into the details now is Brian Kessin, Senior Portfolio Manager at Tortoise Capital. It's good to have you join us. Thanks so much.
Hi, it's my pleasure. Thank you.
So what's going on here? Despite really high oil production, what happened with these lower numbers?
Yeah, I think it's just a matter of the commodity price. And we saw crude oil generally in 2025 trade off throughout the year, starting in April, and we ended the year pretty weak, where oil prices, frankly, ended the year in the 50s. And despite the fact that both operationally Chevron and Exxon are producing at record levels, at the end of the day, commodity prices are a key driver to their overall profitability.
It's also hard at this point to talk about these two companies and not talk about Venezuela, right? And what's happened over the course of the last couple of weeks. And you know, Chevron talking about that too, pointing to Venezuela's promise of more oil in the future. What do you make of what these two companies maybe have in terms of their future in Venezuela?
Yeah, no, it's going to be very topical for both their conference calls. Obviously, Chevron still has operations in Venezuela. They appear to be pretty optimistic that they can bring at least 50% of their current production, add to that in a pretty meaningful way. But it is not very short term. It's over kind of an 18 to 24 month period. I think Exxon's probably an even bigger question mark, given the fact that they're not in Venezuela today, and they think that obviously they're going to need security and some investment guarantees over the very long term in order to re-enter the region. So it remains interesting. It's a great opportunity, but there's a lot of factors that will go into their decision on the future.
What are some of those factors other than the long timeline you just mentioned?
Yeah, I think in both cases, or a couple of times now, Venezuela has nationalized their assets. Most recently in 2007, when both Chevron and Exxon were there, and Exxon just decided to pull out entirely. I think they're going to need to feel that if they make an investment in Venezuela again, that there's enough protection, either from the country, that the political stability is going to be there for the long term, and that the U.S. more or less has their back. That if Venezuela tries to nationalize again, something will happen where their interests are more protected. And that's a pretty high bar, certainly not only for Exxon, but for Chevron as well.
Yeah, because I wonder if maybe there's too much weight or expectation or hope put into Venezuela, given all these factors that you mentioned, and just how long it might take to see results.
Yeah, very much. And I should add that we talked a little bit about commodity prices. Commodity prices are not necessarily supporting increased investment right now in Venezuela, where arguably the break-even costs relative to the rest of the portfolios of both Exxon and Chevron are a little bit higher. That's probably not the best use of their marginal capital right now.
What about Greenland? There's talk of Exxon maybe making a presence in Greenland, maybe Chevron too. What do you make of what could come out of that?
Yeah, I think Greenland probably, frankly, has a little bit more constructive for both companies, given the fact that there's a really unstable political situation in Venezuela, and obviously there's uncertainty as it relates to Greenland. But working with Denmark and other European nations, seemingly it's in everyone's best interest not only to explore for oil and other energy commodities, but even broader minerals. So I think the outlook there is a little bit brighter.
What about the Permian Basin? Like when we're talking about Exxon's Permian Basin, what's the latest there? Is there still a lot of output coming there?
Yeah, I mentioned other places that the companies are looking to invest in, kind of their crown jewels. And Exxon highly covets their Permian operations. In fact, they reported a quarter ago that they were going to continue to increase production in the Permian Basin, targeting 2.5 million barrels per day by 2030. On the conference call, we expect continued support of that. And relative to the rest of the portfolio, the Permian Basin has some of the lowest break-evens for Exxon. So they're not going anywhere here in the U.S.
Wow. Okay. Exxon, Chevron, two very big names, of course. Are there any other energy companies, though, that you're kind of watching for?
Yeah, another one, not necessarily a producer, given the fact they're tied to commodity prices, and we're constructive on that. But one that we do like, natural gas pipeline company Williams. The Williams Companies has arguably the most valuable pipeline in the U.S., transporting natural gas from the Gulf Coast all the way up the Atlantic seaboard, actually into the New York City area. And they're really trying to use all of their assets and their expertise, not only to transport natural gas, but are asking, how can we help bring more power to be it data centers or transport more natural gas for LNG export? And we just think that they're being a little bit more creative than some of their peers are in bringing more power to bear.
Mm-hmm. Constellation Energy, that's another one you're watching out for?
Yeah, Constellation Energy, they're an independent power producer, meaning that they have the ability to benefit from higher power prices. And we look across the U.S., particularly in the Northeast and then the Mid-Atlantic region, and recognize that reserve margins are pretty thin and have a very favorable view on power prices as demand increases. between now and 2030. I'd also add, it's been very cold, very cold recently. People are using a lot of power, and power prices, especially at the spot, has really spiked just here in the first part of the first quarter. So I would expect some outsized profits from Constellation in 1Q.
And just quickly, your last company that you're watching for, you say this is the largest exporter of natural gas in the U.S.
Yeah, that would be Cheniere Energy. The ticker there is very appropriately LNG. Not only are they the largest exporter in the U.S. today, largest publicly traded exporter in the world, and they're not just staying where they're at. They continue to grow their LNG export capacity, and they're able to do that, frankly, without issuing any new equity. And in fact, they have a very sizable share buyback program. They're going to continue to grow their dividend, all the while being an investment-grade company.
Okay, so fascinating to hear about all this. That is all the time we have, though. Brian, appreciate your time. Thanks so much for joining us.
Thank you. It was my pleasure.
Thanks. That was Brian Kessin, Senior Portfolio Manager at Tortoise Capital. Coming up, we will get more insight on the latest moves in the price of gold. That's coming up next. Gold is down below $5,000 on Fed pick and investor caution. For more on this, we're going to get some analysis on the latest moves in gold and silver from Kenneth Hoffman. He's head of commodity strategy at Red Cloud Securities and joins us live now. It's good to have you. Good morning.
Thanks for having me. It's been an interesting time, hasn't it?
It's been an interesting time. It's been an interesting couple of weeks also for the price of gold and silver. What do you make today? We're seeing these prices falling. Is there any one key reason why, or is there just a couple of factors here?
I think actually at the end of the day, we've had a thesis that gold would do very well over the long term, and we're in a long-term gold bull market because of what we call de-dollarization. And I think these past week has showed you exactly why you want to own gold and what is driving gold, which is the U.S. sort of leaving the world market and less dollars being needed, and therefore gold is where you want to be. Why? What we saw this week was, remember on Monday and Tuesday, Japan was trying to prop up its currency, so it was selling dollars and buying yen. That sent the dollar index down significantly. The dollar depreciated in value, and gold took off. What we've seen over the last 48 hours is really the reversal of that trade. Particularly last night with the president nominating, of the 4 people for the Fed, this person seems to be the least likely to sort of lower rates quick. And the market saying, wait a minute, we thought Trump wanted far lower interest rates. Maybe they won't go down as fast, and therefore the dollar appreciated again, and gold and silver really took it on the chin. However, I think Trump's long-term goal has always been, and he stated this many, many times, to lower the value of the dollar. So that tells you as he goes ahead with his quest to lower the value of the dollar, gold is going to have probably a much better run than we thought because of the volatility we're seeing today.
Interesting. I guess all of that just goes to show we are in what we already knew was very unpredictable times, and that continues. So do you think that what we're seeing today in terms of the price lower, a bit lower, is just a minor blip for gold?
I think long term it will be, but again, it's instructing investors to watch the dollar, that gold is really replacing the dollar as one of the world monetary instruments, and that trend is specifically tied to what the dollar does over the long term. And we did see the dollar decline around 10% last year. It's slightly down this year, and I think what's really important about that is as it goes lower, and, looking at the Bloomberg US dollar index here, he wants to target something under 1,000, probably something in the 800 to 900 range. The reason he wants a cheap dollar is to pay off the massive US deficit. But as those things come to fore, that's going to be a very powerful motivator to the price of gold going forward.
I want to talk about the price of silver and even copper if we can in a couple of minutes, but just still staying with the price of gold, right? Like we've seen where gold is sitting. Bitcoin still showing wide price swings. I know everyone talks about gold being that kind of safe haven. Are investors, do you think, maybe taking more of a risk than they realize with gold compared to Bitcoin, or what do you think?
Well, I think the volatility of gold has definitely picked up. It's nowhere near Bitcoin, and I've never been a big fan of Bitcoin, but I am a big fan of gold. And the reason being, that central banks can acquire gold right now. And it's a tier one asset, which it hadn't been in the past. And that is the trend that is your friend, which is central banks around the world, the biggest and most liquid players in the world, have been buying gold and will continue to buy gold. Now, around that is investors positioning, and that's what's giving us sort of the high volatility here. But the trend is your friend here, and silver is less liquid than gold, and so you're starting to see it move around even more higher volatility than gold.
I was just about to ask about silver, right? Because we're seeing it dropping below $100. Is that? I take your point, it's more liquid than gold, but is that some of the same reasons we're seeing gold drop as to why we're seeing silver dropping?
I think they're completely in sympathy, particularly for, remember the big retail has been a big buyer of silver. And I think when, retail tends to, the reason is silver's a lot less expensive. It's a lot easier to buy an ounce of silver than an ounce of gold. And so it typically does have that higher volatility around gold. To me, it sort of has less of a central bank impact, which is why I prefer gold over silver. But the two are always tied at the hip. And in this case, it's they're both showing that same volatility, with silver, which had much more volatility on the way up, showing that pullback, much more volatility on the way back down.
What about the price of copper as well? Like, we've seen copper hitting some record highs recently too. What do you expect to see in the, near future with copper?
I'm less bullish on the base metals than I am on gold. Again, sort of going to what the U.S. is doing in terms of trade. At Red Cloud, one of the things we talked about is chaos will be commonplace, and we don't think that Mr. Trump will change his ways. And so the tariff trade-off and impact on global economies, we believe will send the U.S. economy, into a bit of a 2026 issue. Once we get to 2027, love copper because of AI and infrastructure and electrical, but we think this year could be difficult. We're already starting to see pretty significant weakness out of China, which is the biggest trading partner with the U.S. And I think as other trading partners are less and less inclined to trade with the U.S., it could cause problems for the U.S. economy. And so I think at the end of the day, copper to me is something that has more downside than upside risk at this point in time. Until we get into the huge part of the AI boom, which I think starts to occur after 2027.
Okay, unfortunately, that's all the time we have. We'll have to leave it there. But Kenneth Hoffman, appreciate you joining us today. Thanks so much.
Thanks for having me.
That's Kenneth Hoffman, head of commodity strategy at Red Cloud Securities. The opening bells are next. Stay with us. And here are the opening bells at the NASDAQ. The Fashion Foundation is ringing the opening bell this morning. The New York Stock Exchange, the American Heart Association, to celebrate the launch of the inaugural Go Red Shop with Heart retail giving campaign. And at the TSX, Harvest ETFs is celebrating the launch of the company's new Harvest Premium Yield ETFs. It's time for the first 15. This is BNN Bloomberg. Trading day is just getting underway, so we're going to check in on the equity market. We will start with the TSX. It is down by 1.5% to start the morning. Could possibly be because of those GDP numbers that came out, which were basically unchanged for the month of November. We'll be digging into that later on. And if we take a look at the U.S. markets, the S&P 500 down by 0.2%. The NASDAQ also down by 0.3%. This comes on the heels of Donald Trump announcing what his pick will be for the Federal Reserve, the chair of the Federal Reserve. And if we take a look at CN Rail, this is one of the movers today that we're going to be watching for. Canadian National adjusted its earnings beat estimates in its fourth quarter, and we're going to be digging into that as well. Profit, revenue rise, we'll be talking about that later on in the show. And for movers south of the border, we are now joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Jeff, it's good to have you this morning. So we'll start with Apple. They've got an upbeat forecast, but it's clouded amid fears about rising costs, and Apple warning about this as well.
That's right. This is an interesting one, and it's definitely one worth watching this morning. The stock was up in the pre-market session. Looks like the open here is not as buoyant, down a little bit as we get into the early stages of trading here. But the reason why this is so important to watch today is that just yesterday we had such a sharp sell-off from another of the mega caps tech names, Microsoft. Microsoft came out with their own forecast, which was a little bit less rosy than expected, and they missed expectations. So after market yesterday, when we had Apple results, it was very closely watched to see whether that would be a trend or not. And in this case, the answer is or not. The stock posted, or the company posted, their largest first quarter sales growth in 4 years, thanks in part to sales of its iPhone and a bit of a bounce back in China. They also posted an upbeat forecast. The one kind of fly in the ointment there with that forecast is the company said that that rising memory prices, so rising prices for some of that equipment that it needs, could impact gross margins. So that is potentially why we're not seeing the gains in the regular trading session that we saw in the pre-market session. Looks like Apple's down about 2% right now, but worth watching, as I mentioned, because this is coming right on the heels of that big Microsoft report yesterday, which weighed not only on the tech stocks but on the entire market. That sell-off for Microsoft yesterday of over $350 billion in market cap, kind of evaporating. That was the biggest sell-off of any tech company since the NVIDIA sell-off last year with the DeepSeek AI chatbot from China, kind of spurring fears that maybe there would be a little bit more competition in the AI space than expected. So a big event yesterday.
No kidding. Speaking of big events, you're also watching shares of SanDisk. They're jumping 24% this morning at the opening bells. This is huge. What's going on with SanDisk?
This is a huge move, and it's on the back of another huge move. This stock has already doubled over the course of 2026, and we are on the last trading day of January. So very, very sharp moves here. This is one of those stocks that is benefiting from higher equipment. Apple was saying this morning that their gross margins could be impacted by by memory costs. This company makes memory chips. They also make other computer hardware, and they had blockbuster results this morning. So revenues were $3 billion for the quarter. Expectation was only $2.67 billion. So well ahead of expectations. They earned an upgrade from Raymond James this morning as a result, which said that, and Cantor Fitzgerald came out and said this morning that the beat this morning is kind of remarkable, in part because the expectations were so elevated for this stock going in. And, speaking of margins, Apple's concerned about it. This company apparently is not, guiding towards gross margins of 67%, which is just remarkable.
Absolutely remarkable. So interesting to watch that. Okay, that's all the time we have. That's Bloomberg's Jeff Morgan joining us live this morning. Jeff, appreciate that. Thank you. Coming up, we will dig into the latest reading on Canada's economy, and we'll also discuss U.S. President Donald Trump's pick for the next Fed chair. Stay with us. Investors have a lot to digest this morning. Canada's November GDP, a slew of earnings, and U.S. President Donald Trump has chosen a new Fed chair, Kevin Warsh. Let's get some perspective on all of that. Andrew Pyle is Senior Investment Advisor and Senior Portfolio Manager at CIBC Wood Gundy. Andrew, it's good to have you. Thanks for joining us.
Pleasure. Thanks for having me on.
A lot to talk about. We're going to start with Canada's GDP numbers for the month of November, basically unchanged. What are your thoughts on that, and how might that kind of weigh in on the markets today, do you think?
Well, it's really not going to have too much of an impact. I think economists were expecting a light month. The Stats Canada is indicating perhaps a 0.1% increase in GDP in December, although that is a very early estimate of how things were last month. It does raise the suggestion of a contraction in real GDP for fourth quarter. And as we know, technical definition of a recession is 2 consecutive negative quarters. Again, premature to see how Q1 is going to pan out. Again, not much of a surprise here because we knew the auto sector was hit. We saw production there down 6.4%. That was obviously the drag on manufacturing. Without services, the number would have been quite a bit worse.
Okay, so let's move on then, just because those numbers were relatively unchanged. Another big piece of news coming out today is U.S. President Donald Trump, of course, saying that he would choose Kevin Warsh as the new Fed chair. Of course, this has to be approved. But first of all, like Kevin Warsh, he does have a history of being, within the bank's board of governors. What do you make of him and this choice by Donald Trump?
Well, it's an interesting choice because while Warsh is obviously a key supporter of Trump and has been for a number of years, Warsh is also defined as a hawk amongst Fed officials. Case in point, he has been very hard on inflation going back. At one point during the financial crisis, had made an argument for raising interest rates and not cutting interest rates. And of course, Trump, as we know, wants interest rates down to 2% or lower. So that's interesting. Warsh is also known for his views on the Fed's balance sheet and very much wants to see the Fed bring that balance sheet down. What that would entail would obviously be upward pressure on long-term bond yields. And you're seeing that this morning in global bond markets, because as we whittle down the Fed's balance sheet, that means obviously we're releasing supply into the market, and that will tend to put upward pressure on yield. So it's an interesting choice if you're talking about affordability on mortgage rates or just interest rates in general.
Do you think he's maybe, like out of some of the other picks that we thought Donald Trump might go with, is he maybe a less controversial pick?
I would say so. I mean, he's got credibility with the Fed. He's got credibility in the markets. He's got experience on the Fed as a past Fed governor. So the markets are going to be comfortable with that. And I think markets are also going to be comfortable in the fact that if you're picking someone that has had a hawkish leaning at a time when the Fox News headlines has been for lower rates, that might suggest that fears over Fed independence might diminish somewhat as well. And again, this is early days. But it's an interesting pick. We are seeing it reflected in the yield curve. The U.S. yield curve is steepening. Obviously, rate cuts at the front end, reduction in the Fed's balance sheet, obviously being an upward influence on longer-term bond yields. So we'll have to see how this shakes out. Of course, to get him in, as one senator has put it, we need to see the issue with Jerome Powell resolved before any candidates will be advanced.
Mm-hmm. Okay, so we'll watch on that front and see what happens there. A lot of earnings coming out this week, and I want to turn to some of the earnings we're seeing today, including the Canadian National Railway beating on profit and revenue. What do you think of the company? Do you think that's a buy after what we're seeing today?
I think these are great results. I think I would argue that the results are probably better than what many would have expected, especially given the activity on the economic front in the fourth quarter. Clearly, CN has done a great job, mainly on the efficiency ratio. I mean, the company's done a really good job in that regard. But we've seen revenue up, we've seen shipments up, and this has been one of our themes for the last several months: is these plays in Canada on transportation and storage, CN being one of them, as we start to see more cross-provincial border trade, and I think that will continue in 2026.
Chevron also beat as well. What do you make of some of these energy companies right now, particularly everything we've seen since the start of 2026, which really wasn't that long ago?
Well, it's interesting because Chevron coming into these results really was not favored over the likes of, say, Exxon, which is seen as stable, solid balance sheet. Chevron, there's been a lot of question marks. Having said all that, the company did come out, obviously, with a profit decline. But that decline was a lot less than what analysts had expected. So I think you're going to see, some upward moves in the stock today. Venezuela is critical with Chevron. Chevron does stand to benefit, provided, we can get a stable situation in Venezuela, get operations back online. Some analysts will see Chevron perhaps as the underdog for 2026.
We're also watching the Canadian dollar today. It was down last time I checked. I'm not sure whether that's the GDP numbers coming out this morning, bringing it down slightly. Yeah, it's still down. What do you make of the U.S. dollar, obviously under a lot of pressure right now? Is that good for the loonie, do you think?
Well, anything that causes the U.S. dollar to lose favor, and again, we've got Trump back again, supporting the dollar debasement view in the market that we've seen in the last week to two. The Canadian dollar is clearly benefiting from that, as we were seeing the euro and even the yen this week. So I think that's a trend that's going to continue, considering that we still have significant uncertainty with respect to U.S. policy. We'd argue maybe on that point that, with this appointment for the new Fed chair, that could give the U.S. dollar a bit of a lift as the markets view him probably as more credible, more hawkish than other candidates. So you could see the U.S. dollar pick up some strength. coupled with the fact that GDP really wasn't a great print for Canada, that could weigh on the Canadian dollar short term. But we still are strongly in the camp that the US dollar still has some major headwinds to go through as we proceed through 2026.
Just lastly, like there's so much to wade through right now. And as you say, a lot of uncertainty still. I think it's pretty safe to say we're going to see some uncertainty for a while. There's geopolitical risks that we haven't seen in some time. How do investors try to wade through this? Like, where do you think is the right place for investors to go or to look to?
Well, I think investors have to stay invested. We've been arguing this point for a while now. Like coming out of the market on headlines really doesn't make any sense. Having said all that, you still have to, have some defense in your portfolio. So we're looking more at things like utilities, things that would stand up if we were to see a hit. As we talked about a couple of weeks back, the stage is set, I think, for 2026 to be a more volatile year, and B, to be a year where we probably will see one or two significant pullbacks in the general markets. And I think your portfolio has to be prepared for that. But having said all that, the setting changes weekly. Today, the announcement on the Fed chair, I think, is reasonably market positive. But going into next month, we don't know what to expect.
That is for sure. Okay, that's all the time we have. Andrew Pyle, Senior Investment Advisor and Senior Portfolio Manager at CIBC Wood Gundy. Appreciate your time. Thanks so much.
Thanks for being.
Yesterday on Market Call, we were joined by Richard Orrell. He is a portfolio manager at RN Croft Financial Group, and he was covering exchange-traded funds. His top picks were BMO, MSCI USA High Quality Index ETF, Franklin International, and Global X S&P TSX 60 Covered Call ETF. Today on the show, we have Brienne Gardner. She's a portfolio manager and senior wealth manager at Velocity Investment Partners, Raymond James, and we'll be taking your questions on Canadian and U.S. large caps. So stay tuned for that. Meanwhile, coming up, Visa has released better than expected results for their fourth quarter. We will get analyst reaction on that right after the break. The earnings parade is in full force this week. Visa beat estimates bolstered by stronger spending, and this comes just after the credit card company announced they will plan to allow their cardholders to spend their cashback rewards on new so-called Trump savings accounts. So for more on this, we're joined now by Nate Svensson, Senior Equity Research Analyst at Deutsche Bank. It's good to have you join us. Thanks so much.
Yeah, thanks for having me, Lindsay.
Let's get into the Donald Trump news in a moment. But just to start, the shares price is up now after the opening bell, but it was trending down this morning. Why do you think that is for Visa?
Yeah. Listen, all told, these were really solid results from Visa, but I think there were a few puts and takes that I think were weighing on the stock this morning. I guess starting with the positive side of things, Visa had a nice beat on the top line. This was underpinned by consumer spending growth remaining resilient. Volume and transaction growth came in right in line with our estimates for the quarter. And Visa's value-added services business continues to grow really strongly. It grew 28% in their fiscal 1Q. Company also benefited from incentives, which is a contra revenue line item that came in a little lighter than expected, mostly due to deal timing. On the flip side of things, there are some takes. Margins were a little bit softer than expected. OPEX growth was higher than the company guided. They guided a low double-digit growth. They came in at 14% on an adjusted basis, mostly due to marketing spend around the Olympics and the World Cup. That led to a smaller beat on the bottom line. EPS was 3 cents above consensus relative to the about 300 basis points of outperformance on the top line. There's also this topic of international transaction revenue growth. Investors we speak to spend a lot of time focusing on cross-border volumes at Visa because that is a high-yielding revenue stream for them. The spread between cross-border volume growth and international transaction fee growth was wider than expected this quarter. Visa benefits from FX volatility. FX volatility came in lower than the company had anticipated, and that weighed on growth in that particular line item. So puts and takes altogether, the consumer remains healthy. The consumer remains resilient, both in the U.S. and globally. You put all of that together, the company was able to reiterate its 2026 guidance both on the top line and bottom line. In our preview note that we published ahead of earnings, we said that that's what we expected would happen. I think there were some investors that were maybe hoping for a little bit more, maybe a guidance raise on the top end, especially in light of really strong 1Q results. And so I think you put all those factors together, that probably explains what was going on with the stock this morning.
Interesting. Okay, with all that said, though, like the company's fiscal second quarter outlook implied a, quote, step down in sequential growth. What do you think that'll mean for the company moving forward?
Yeah, I think that was pretty well understood by most investors and sell-side analysts. Listen, a lot of this gets into comps, year-over-year growth comps. They grew really, really strongly in their fiscal 2Q last year. The comp gets a little bit harder. So on a like-for-like basis, sequentially, growth is stepping down a little bit. I think the company had done a good job at communicating that ahead of time. So I don't think it was a real surprise to investors. They guided to low double-digit growth on an organic constant currency basis in 2Q. We were at 11% heading into earnings. So not a huge delta. I think that was well understood. And then comps will get easier in the back half. So growth should continue to improve from here.
Okay, so let's bring in Donald Trump now, because earlier this month, Trump did announce the Credit Card Competition Act, which is placing a 10% cap on credit card interest rates for 1 year. How do you think this could affect Visa moving forward?
Yeah. Listen, it's been tough. We still like Visa. We're buy rated, $410 target price. Shares have underperformed year to date. A lot of that is noise coming out of DC and coming from Truth Social posts. So you brought up two separate topics. They are interrelated, but two separate things. There's the Credit Card Competition Act, and there's the proposed 10% interest rate cap on credit card interest rates. So two separate things. The Credit Card Competition Act, I'll take first. So this is a piece of proposed legislation that has been floating around since 2022. I think it was first introduced as a potential bill in 2023. And it's been dead on arrival for the last few years. So it does have bipartisan sponsors, Dick Durbin and Roger Marshall. One's a Democrat, one's a Republican. But there's broad-based bipartisan opposition to this bill. Hasn't really been able to take off the ground. Trump did throw a wrench into things when he posted on social media about this a couple of weeks ago, seeming to throw his weight behind that. He has obviously made consumer affordability a key focus for his administration heading into the midterm elections here later this year in the United States. We still think the base case is that the Credit Card Competition Act doesn't get enacted. There is still that broad-based bipartisan opposition to the bill. Visa management on the earnings call last night was pretty adamant that they think the CCCA, as we've been calling it, is negative for consumers, and they're doing a lot of work to educate legislatures on the negative impacts that could come about because of CCCA. The other topic, the proposed 10% cap on credit card interest rates, just to clarify, there's no direct impact to Visa's business model. That is from the issuers, the banks that issue your credit card, whether it's Bank of America, TD, whoever it happens to be. Visa is a network in the middle. So we don't think that one gets enacted either. You listen to the earnings calls from all of the big banks, from all the other credit card issuers. They've been pretty clear that if there were a 10% interest rate cap, there would be a reduction in credit access for consumers in the U.S., particularly for low-end consumers. So if the administration is placing this focus on affordability for low-end consumers, and they do this cap, it would actually reduce their overall spending power. At least that's been the messaging from bank and credit card issuing CEOs. So there are risks, definitely headline risks, and then we think that's what's been weighing on Visa shares so far year to date. We think probably low likelihood that either of them get enacted, and I think the administration is going to focus on other areas where they can have a more tangible impact on consumer affordability going forward.
What about Visa's plan to allow cardholders to direct cashback awards to the new Trump savings accounts? Like, I think it's surprising how much you're seeing Visa intertwined with politics this week. Nicki Minaj was even involved. It sounds like a weird dream. I mean, there's just so much been going on. What do you make of that part of it?
Yeah. I was surprised to hear Nicki Minaj and read about that on Bloomberg. Listen, Visa is going to do everything it can to enable the most optionality for the consumers using their cards. I think from what I've been hearing, it seems like there's going to be really strong uptick for these savings programs that the administration is implementing here in the U.S. Visa wants the users of their cards to be able to benefit and use rewards to kind of help build the financial stability and foundation for their children going forward. So I think ultimately, with regards to the fundamentals or the outlook for Visa, it is something very marginal. I don't think it's going to have any material impact on growth or the business's trajectory either in this year or in years going forward. But Visa wants to enable that flexibility and that optionality for their consumers. And whether it's these Trump savings accounts or whether it's anything else that the consumer wants, Visa is going to work to enable that over time.
Okay, that is all the time we have, Nate. It's so good to have you on. Thanks so much for breaking everything down for us. Appreciate it.
Yeah, I appreciate it. Thanks for having me.
Thank you. That's Nate Svensson, Senior Equity Research Analyst at Deutsche Bank. Coming up next, Wall Street is looking for big tech to justify enormous AI capital expenditures after years of unchecked investment. We've got more on that coming up after the break. Tech companies are feeling more pressure to prove that their massive AI spending is paying off. So for more on how Wall Street is measuring their progress, let's bring in BNN Bloomberg contributor John Ehrlichman. John, good to see you. So John hosts Ticker Take on YouTube. He has a new story on our website about this topic. And John, Microsoft this week, that was an example of this pressure that companies are currently feeling, right?
Yeah, Lindsay, exactly. That was definitely the prime example of the week, because there's no doubt Microsoft is growing by implementing AI into all of their enterprise tools, but the stock got hit hard in part because there was a belief that they're just not growing fast enough to justify all of the spending. So we spoke with Mark Mahaney, who's a longtime analyst who's been covering tech stocks, and he's drilling into individual company stories to see what are the ways we can make sure that the companies are getting back what they're putting into AI. And there's a whole bunch of different ways, but just to give you a couple examples that Mark shared with us, if you're looking for the growth, the bump from AI, how much revenue per employee is being generated by the company? There's a general belief that if AI can help companies to be more productive, you should see a bump there. And I guess on the other side, because a lot of people wonder about profits, are margins getting better? Is there signs or evidence that the company can do more with less? That should trickle down to the bottom line. Not perfect measures, obviously, but a couple that are starting to get more attention, Lindsay.
So you mentioned Mark Mahaney. He does a few examples of some stocks he likes because of AI growth, but also that have cheaper valuations. What are those?
Exactly. Well, we talked to him as well because given the run-up we've seen in stocks, I think there's, a pressure on the analysts themselves to come up with investing ideas of companies that have reasonable valuations. So when you put the AI measurement with the valuation measurement together, Mark has three names in particular for 2026 that he likes. One is a massive company in Amazon, just because in his view, when you look at the valuation of the company and the AI that they are implementing into their business, it still gets big check marks. Expedia would be another company that has long been undervalued by the market, just doesn't get as much attention as some of the other travel giants. And so he likes Expedia right now. And DoorDash is an example where they've made some big investments, but you can see the drop off that we saw in the stock. And he feels like those will benefit the company and maybe investors over the long term.
Okay, so interesting. John, always good to see you. Thanks so much for that.
See you, Lindsay. Thanks.
And you can find John's latest story on the BNN website and the Ticker Take YouTube channel. Coming up, what this round of earnings is revealing about margins, spending, and the broader economic backdrop. That's coming up with John Zechner after this. Hi there. Welcome to the second hour of The Open. We're going to take a look at some of the stories we're following in the BNN Bloomberg newsroom today. Canada's economy stalled in November with the GDP flat compared to the month before. Economists were expecting a rise of 0.1%. Data from StatsCan shows the drag came from goods-producing industries, which fell for the third time in 4 months. Meanwhile, services industry saw an increase driven by higher retail spending. Looking ahead, StatsCan says GDP likely rose 0.1% in December. We're tracking shares of Canadian National Railway today. The company reported higher profit and revenue for the fourth quarter thanks to better freight volumes and improved operational efficiency. Revenue rose to $4.5 billion, and CN boosted its dividend by 3%. The rail company expects volume growth to be flat this year, though, as it expects to spend roughly $2.8 billion in capital expenditures. U.S. President Donald Trump has threatened to impose a 50% tariff on aircraft from Canada sold in the U.S. Trump also says he will decertify all new planes made in Canada until Ottawa agrees to approve certain jets made by Gulfstream, which is a unit of General Dynamics. Bombardier says it has taken note of Trump's post and is in contact with the Canadian government. We're going to take a look at the TSX this morning. It is falling slightly today, down 2% at the moment. Of course, we're seeing that news coming out of GDP numbers for the month of November, relatively flat, possibly affecting the TSX today. And if we take a look at the U.S. markets, also trading down to start the day. Of course, big news out of the White House with Donald Trump announcing his pick for the new Fed chair. You can see that's affecting the S&P 500, the Dow Jones, the NASDAQ, all down slightly today. A little bit of uncertainty on the markets, and we'll, of course, continue to follow that. Investors are sifting through a slew of earnings results, and to add to that, the latest GDP report offering an important read on Canada's economy. So for more, we are joined now by John Zechner, chairman and founder of J. Zechner Associates. It's good to have you join us today.
Hey, good morning, Lindsay. How you doing?
I'm good. I hope you're doing well, despite all the news that's coming out today and this week. It's been a busy week, and earnings as well. So we'll start with Meta and Microsoft. I'm wondering, they've got this massive bet on AI and infrastructure. How should investors be looking at what we're seeing coming out of those two companies?
Well, it's interesting, Lindsay, because that really was a division in the performance of both of those stocks, after the earnings release. And clearly, investors are getting a little more skeptical about the spending on AI going forward. And, the amount that's been put in and the fact you got negative free cash flow from a lot of the big hyperscalers now, whereas they used to be big, free cash flow generating machines. And I think the big issue is, when are you going to start to monetize that? When are you going to start to see some results from it? And I think the reason Meta was sort of one of the few to go up yesterday, they really showed that, they gave a revenue increase, and they're showing how their applications are getting sort of more use because of AI, whether it's, the built-in app, the WhatsApp, the Instagram, the Facebook, and all the associated programs as well, as opposed to, Microsoft, which just continues to spend, and they're not seeing, an increase there. So I think that's the worry. They want to see some absolute monetization, and how this is going to translate into revenue growth. And I think that's the thing. On the other side of the scale, you've got the worst performers are companies like Oracle, because all they're seeing is spending without any associated gains in revenue yet. So I think that's going to be the bit of the tug of war. And right now, the tech stocks have been really underperforming for much of the past 6 months. It's been the real economy stocks that have been doing better, and that's despite some decent numbers. I mean, you look at, Celestica yesterday was down 16% on a beat and raise, but it's just, how much longer can they sustain these levels of spending while they're big customers? Apple, obviously, they had a decent beat because of iPhone sales in China, but then on the other hand, people are worried about the cost structures and particularly the memory costs going higher. So there's a lot of balls up in the air right now, and I think the net is, the stocks have had a fantastic run over the past couple of years, and people are becoming a little bit more selective about what's going to work and what's not going to work, and they're not going to pay for the big multiples for companies that are only spending and not seeing revenue generation.
Do you think it takes some time, though, when we're talking about that spending, or do you think these companies, I know we were talking about this at the end of last year too, like that potential overspending in AI, do you think companies have had that time and we should be seeing results by now?
Well, I think you're at that point where the question is coming up a lot more, and it's hard for anyone to know at this point what the ultimate productivity gains and the usage and the improvement in the revenue generation is going to be. But the scale is just so massive. When you talk about spending trillions of dollars in capex and data center increases and everything else, I mean, in order to get a normal return on equity or return on investment on this, you got to be talking about hundreds of billions of dollars of annual improvement, either in productivity, cost gains, or revenue gains. So the numbers are just astounding. So yeah, there might be a chance that they overspend. I mean, that was what sort of led to the end of the bubble in 2000 was the fact that you overbuilt fiber in the ground, and at points, especially when people weren't paying for it, these companies had to sort of take it in, and they started losing money, and that's when they all started dropping. I'm not saying that'll happen again, but there's going to be a lot more scrutiny on it, and investors generally generally tend to, be where there are those kinds of questions. There's a little sell now and sort of look at it and make a decision later or switch to something else. And in the meantime, hey, commodity prices going higher. Other stocks are looking better in the index, and that's why I think we've seen this shift in the past couple of months.
Okay, so interesting. We'll keep an eye on that. In the meantime, moving on from AI, Chevron also beating expectations despite some weaker oil prices. What do you think is going to be happening with that company in the near future? Or what do you think of their results, given everything that's been happening over the last couple of weeks, particularly in Venezuela?
Well, yeah, that's a good point, Lindsay. And I think that January 9th meeting in the Oval Office or wherever it was with the White House with, Exxon and Chevron and all those players, I mean, that was, they told the story as it is. We're not going to rush into Venezuela and start, spending tons of money and bring their, production back on. And Chevron and Exxon, we both reported this morning. And yeah, they sort of beat on cost cutting mostly and some better production, certainly not on stronger oil prices. But, Exxon is still was basically, their production was confiscated. Chevron is still there to a degree, but there's no infrastructure there. I mean, how are you going to start drilling? You've got no power. You've got ability to go in. You have security concerns. So I mean, there are other places right now that I think these companies can make better economic decisions in terms of where they want to invest. And Venezuela is not at the top of the list, despite what Trump seems to want on that. So it's going to be a bit of a push and pull there. And he clearly continues to exert his influence on all of corporate America and in the corporate world. And we saw it again, this morning with, Bombardier and other things like that. And he's certainly not going to take his hands off the wheel. That's not his modus operandi. But in the meantime, these guys are making economic decisions, and those economic decisions are saying don't go and invest in Venezuela right now until things improve dramatically on the infrastructure side.
You say there's other places that these companies should be looking at other than Venezuela. Just quickly, because I do want to get to CN Rail. What other places are you talking about?
Oh, you still got the deep basins. You still got natural gas exposure. You still got diversification. Some of them at point may look at alternative energy sources, offshore drilling, other things like that. I mean, I don't think there's any shortage of places where they can drill in the world. So, yeah, you got to take geopolitical risk out of the equation, and geopolitical risk and infrastructure risk are higher in a place like Venezuela. Absolutely.
Okay. All right. So now CN Rail, they reported a boost in profit and dividend. Do you think the company's heading for kind of greener pastures and stronger growth in the future now?
Well, the numbers were good, just like CP reported yesterday, and they're getting the cost under control, which is sometimes the only thing you can do in a slower growth environment is really cut your costs and bring that in line. And they're obviously all at risk for what's going to, continuing tariff trade and those unknowns. But I guess the disappointment a little with CN Rail versus CP yesterday is that their guidance for the year was relatively flat. So maybe they're just being realistic. They're setting the bar low and hoping to sort of overachieve that. The rail stocks are looking a little more interesting to me than they have in a while. They had a premium valuation for a number of years, and now they're sort of mid to high teens earnings for I think decent growth going forward, and particularly in Canada on the east-west, because what we're seeing on the commodity side and our need to sort of get more products to market internationally. I think rail is a clear winner on that. So I've added to both of the rail names in Canada recently. I think they both look relatively good. They've been cheaper, and there's still a decent play on ongoing economic growth.
Okay, more news coming out today from Donald Trump as well. More threats, more tariff threats threatening Canada's aviation industry, a decertification of Bombardier planes. Do you think Bombardier as a company should be worried at this point or be worried about how they're going to stay competitive, or are these just words, do you think, from the president?
I think, Lindsay, they're more words. I mean, we owned this stock for a while, but we sold it last year, but that was strictly on valuation. When we bought the stock a few years ago, it was basically trading at 8 times forward earnings and 3 times operating cash flow. Now it's trading around, 13 times operating cash flow. So it just, it just had too good a move. Now, having said that, what Trump said this morning, that just seems like a really hollow threat. Like, first of all, the certification, he doesn't decide that. The FAA decides that. So that's a long way to go to say they're going to decertify those planes in the U.S. I mean, yeah, like I say, there's an organization, a body that will make those decisions. And in Canada, I mean, yeah, there's there's some decisions being made yet on some approvals coming in from U.S. planes, but that just takes time. So Trump sort of just sticks his fingers in all of these things, and I don't know what he does in the middle of the night. He sort of sees this and he makes a comment and makes a threat. In the end, I don't think this is a very real threat. I think I saw bomber stock this morning. It was considering how serious that would be, so given how many planes they sell into the U.S., the stock wasn't really reflecting those worries. So I think people are starting to take some of these pronouncements and slide. There is more of this kind of taco trade aspect to some of the threats that he makes.
It is hard to keep track at this point of all the talk and the rhetoric. That's all the time we have, though. John Zechner, chairman and founder of J. Zechner Associates. Thanks so much for being here. Appreciate your time.
Thanks, Lindsay.
After the break, we will get more from the CEO of Coveo on the company's latest earnings. That's next. Canada-based technology company Coveo Solutions reported the strongest new booking performance in its history and revenue that came in above management's guidance. Let's hear more on this from Laurent Simoneau, CEO and co-founder of Coveo. It's good to have you. Thanks so much for joining us.
Good morning, Lindsay.
So tell us more about this new kind of record your company set. What are you attributing these numbers to?
Look, it's been a great quarter on all fronts. As you said, we achieved a record quarter in terms of new bookings performance, so the highest in company history. This performance was driven across all primary solutions areas. So think about commerce and knowledge solutions. And they were diversified in new logos, what we call land, and expand transactions. So existing customers that are buying again. So we signed major new contracts with leading brands such as Boston Scientific, United Airlines, Deloitte Digital, Liberty Mutual, Thomson Reuters, Vanguard, and to name a few, right? And what's also great, in addition of that, we secured the largest new customer win in Coveo's history, a 7-figure annual subscription with a Fortune 500 global leader in the industrial sector. So all in all, great quarter, record quarter, and it's been great for us.
You did imply, though, the guide for Q4 subscription revenue did come down a bit. So I'm wondering, but it still looks like your company does have good momentum moving forward. So with that in mind, why the lowered guidance?
Yeah, we don't want to get ahead of ourselves. You've got to remember also that next quarter there's less days in the quarter. So because we recognize daily, so you have to reduce it a little bit. But all in all, we are very confident. We're very confident about our ability to deliver, and we increase our guidance to the highest of the range of previous guidance. So we're confident about our ability to deliver.
There's obviously, for any tech company right now, kind of finding your way through the tech and AI sector, there's so many changes happening. I'm wondering what challenges your company has had to overcome. I know you talked on your earnings call also, but you now have a better understanding of the market. Can you explain that further and some of the headwinds, I guess, that any company in this sector is facing as we head into 2026?
Right. So what has been very good for Coveo, and this quarter reaffirms what we've been saying for some time, is that large enterprises, they need AI to be grounded on their secured, relevant content data. You want your ChatGPT Enterprise or your Microsoft Copilot or any other ones to give you answers based on your content that is secured, that is relevant for the enterprise. And that's what Coveo does really well. Now, what we have launched this quarter, and it has already, it's gaining great momentum, is the ability for a technology that we call MCP server. It's the ability for users of these AI solutions to connect Coveo in a few clicks to them. So think about ChatGPT Enterprise or Anthropic Claude, to include Coveo part of that, so the answers can be grounded on Coveo data that is secure, that is relevant, and that is personalized to the user. So we believe this has great momentum, and our customers love it.
Your company signed an MOU with the Canadian government, I believe, in December, so just last month. Can you go over exactly what the outcome or the goals of that MOU are with your company and the Canadian government? Like, what are you hoping to help the federal government with?
Absolutely. So as you mentioned, we signed the MOU about a month ago. So it's still early, and it's not a formal agreement, but that's how the government typically works, in a way that it provides a framework for us to be in a favorable position to solve government problems in the future. So we're encouraged by the early talks we're having with them. Now, the bigger picture is we believe the government of Canada is very intentional in its desire to modernize with tech and AI. And there's a significant opportunity to leverage this new technology and AI for Canadians so they can improve their self-service with the government and also help government employees gain productivity with this. We already doing a lot of work with other governments around the world, in addition to our large organizations. So the government of Australia, of New Zealand, City of New York, State of Tennessee, to name a few, are all using Coveo to improve their self-service with their citizens and improve their employees. So we think there are huge opportunities for productivity gains. These are billion-dollar opportunities. So we're really excited to work with the federal government in the future to achieve some of those gains.
Just in our last minute here, like you mentioned, the federal government, obviously there's a lot of geopolitical tensions right now, trade tensions with Canada. Does that affect Coveo at all?
Not at this point, and we don't look. We do not control the bigger geopolitical tensions that may happen. But the way we work, Lindsay, is we are a cloud service that runs in the U.S. for U.S. customers, in Canada for Canadian customers, in Europe, and so on. So what we provide is a subscription to our U.S. customers and international customers. So we think that we're well balanced right now, and we are well protected against any future, I would say, friction that may happen into the geopolitical space.
Okay, that's good to hear. That's all the time we have. Laurent Simoneau, CEO and co-founder of Coveo. Appreciate you taking the time today. Thanks so much.
All right. Thank you, Lindsay.
Thank you. Well, coming up next, the ETF report. That's next. Stay with us. Now it's time for our ETF segment, and our next guest manages the First Trust New Constructs Core Earnings Leaders ETF. It has beat the S&P 500 over the last 12 months. So to find out more, joining us now is David Traynor, CEO of New Constructs. It's good to have you join us. Thanks so much.
Thanks for having me.
Let's start with that Core Earnings Leaders Index. Tell us why you think it's been beating the market for so long.
I think it's because it's based on real diligence on earnings. You know, it used to be back when I started in the business, people really cared about earnings, and people still care about earnings today. But what they miss is that as corporate filings have become 200, 2,000 pages, there's all kinds of critical details buried in footnotes. And the Core Earnings Leaders Index outperforms because we have a better measure of earnings. We've done the diligence in the footnotes, and this product chooses stocks that have the biggest advantage in terms of core earnings edge, core earnings minus reported earnings. And that is, I guess, proven to beat the market pretty substantially in the last several months.
Looking at the top holdings in that ETF, like we've got Meta, IBM, NVIDIA, do you think that might change heading into this year?
I think it will. I mean, these guys have been super profitable companies, but AI is changing not just asset allocation, and the way people pick stocks, but I think it's changing the economics of a lot of these big businesses where the spending, and we wrote a nice report on this about the AI winners and losers, the spending is so big that it's even putting companies, Oracle, Meta, and Amazon, on their heels because they actually don't have the cash flows that like an Apple and an Alphabet do to sustain the race. And so, yeah, I think the earnings profile of a lot of these companies is going to change a lot.
We were speaking earlier with another guest about, spending and AI when it comes to some of these big companies and how there's been a lot of spending and maybe not seeing results that investors maybe want to see. I'm wondering, what are your overall thoughts on investing in big tech right now?
I think you got to be careful. And I think that's part of the reason why the core earnings leaders ETF has done so well is that you can't just blindly throw money at an index and assume that diversification is going to solve your analytical problems. You can't just blindly throw money at popular stocks anymore. You got to do the diligence. I mean, what's wrong with diligence, right? Maybe it's going to come back into favor when you see performance like what we saw up 27% versus 18%. So I think people got to break out their calculators and their notebooks and their pencils and their models, read footnotes, find out what the truth is, make sure you're investing based on companies that are the most profitable and avoiding those that are least profitable, and especially avoiding companies that are overstating their profits because they're bearing all these charges where you can't see them in footnotes. So I think the big thing is diligence, and know what you're buying, know what you're selling, do the diligence. And I think the core earnings leaders ETF proves that if you do that, you'll outperform.
AI valuations, they have become more scrutinized by Wall Street recently. Do you agree with that?
Absolutely. I think we're running into the law of large numbers, right? I mean, these valuations got so big, and we know we're running into the law of large numbers with respect to our national debt, our spending, right? There's no longer this sort of this idea that there's an infinite amount of money out there, whether it becomes the government or I think for investors. What that means is now people are becoming, on the margin, more discerning. More discerning is super helpful to those of us who want to be analytically rigorous in how we invest. Because as long as people are at least somewhat discerning, then the market's going to send capital to the companies that produce the most earnings. That concept still works. Earnings still matter. The key is to make sure you're paying attention to the right earnings, because there's two sets of numbers out there. There's what Wall Street and companies want you to believe, and then there's core earnings. And if you can get to core earnings, you have an advantage.
It's interesting, going back to your holdings, General Motors is among the top of them. Given the uncertainty right now within the auto industry, we're talking about all those layoffs happening at General Motors today, why GM?
GM makes so much more money than Tesla. The cash flow is outrageous. The capital return, the amount of stock they're buying back, is outrageous. GM is a perfect story of being maligned by the media. People get so excited about ESG or electric vehicles or all these things, and it's not that those things are bad. ESG and electric vehicles are good, but not to the extent that the valuations implied for certain stocks. Meanwhile, all GM is doing is generating billions of dollars in free cash flow, great earnings every year. Mary Barra, great CEO. The executive compensation there is tied to return on invested capital. They've got awesome distribution. They've got the ability to make all kinds of cars, affordable cars, electric vehicles, trucks, expensive cars. It's an extremely well-run business. It just gets a bad shake because the media doesn't like it as much as it likes the electric vehicle companies, and it's just been overlooked. And this has been a core focus list holding for us for a while. We're glad to see the market become more discerning. I think it's a poster child for, hey, at the end of the day, I don't have unlimited amounts of money to throw around. Where should I place my bets? And GM is a great place to place a bet right now with respect to economics and fundamentals and competitive positioning.
What about your thoughts on investing in financials? I see JP Morgan, another top holding.
Another huge free cash flow maker, another great core earnings generator, super profitable business, well diversified, still cheap. Financials aren't going away. This is one of the biggest and best players, one of the best risk managed firms in a long time. Jamie Dimon, CEO, one of the most respected business leaders across all sectors. What's not to like? Maybe it's not sexy, maybe it's not in high flying NVIDIA AI stock, but it's I don't like to invest based on sexy. I like to invest based on core earnings and cash flow because I think that's what wins over time. And I think the market's proving that to be a good, sound strategy.
Okay, we will have to leave it there. We're out of time, but appreciate you joining us today. Thanks so much.
Thank you.
That was David Traynor, CEO of New Constructs. Coming up, we will have your latest headlines, and then we'll get analyst reaction on Apple's record sales this quarter. However, investors are worried about rising component costs, so we'll dig into that next. Canada's economy stalled in November with GDP flat compared to the month before. Economists were expecting a rise of 0.1%. Data from StatsCan shows the drag came from goods-producing industries, which fell for the third time in 4 months. Meanwhile, services industries saw an increase driven by higher retail spending. Looking ahead, StatsCan says GDP likely will rise 0.1% in December. Shares of Imperial Oil are in the red today. The oil producer and refiner posted profit and revenue in its latest quarter, which fell due to lower oil prices. Imperial's net income also saw a 60% plunge due to charges related to the write-down of an aging oil field. In addition, production from its oil sands assets in Alberta also saw a drop due to weather conditions. Despite the disappointing quarter, Imperial raised its dividend by 20%. And shares of American Express are trading lower after the credit card giant reported profit and expenses that fell short of Wall Street expectations. On the upside, revenue topped estimates and Amex posted higher than expected transaction volume. The company is also raising its dividend by 16%. And we'll take a quick look at the North American markets today. The TSX, S&P 500, NASDAQ all down. A lot of uncertainty today. Of course, those GDP numbers affecting the TSX possibly. And some news coming out of the White House. Donald Trump making his pick for the next Fed chair. And that seems to be affecting the markets and investors ever so slightly south of the border. Shares of Apple are trading lower today after the company posted mixed Q1 results. It said it's expecting challenges from memory price hikes and potential shortages. However, it also reported record sales and a forecast that surpassed expectations. So here to give us his perspective is Mark Newman, Managing Director and Senior Analyst covering technology hardware at Bernstein. It's good to have you join us. Thanks so much.
Absolutely. Thanks for having me today.
So the company warning of rising prices, putting pressure on their margins. What parts of the supply chain are you seeing that are kind of under the most strain here?
Yeah, definitely. Memory prices and shortages are the biggest issue facing all smartphone makers. Tim Cook and the CFO, they highlighted issues with memory prices. But despite that, the company printed an amazing revenue and EPS, an all-time high revenue, all-time high iPhone revenue, and strong gross margin, including the guidance for the quarter. So they talked about the concerns for memory prices, but right now, it's not really impacting them at the moment.
Okay, so I do want to move on, but just staying with the concerns of higher prices, do you think it will be impacting them soon? Because obviously, like when you talk about the iPhone, it's already more expensive than some of its other competitors' phones. Do you think is there a concern that customers might start going elsewhere?
No, I think the issue for Apple, as for all smartphone makers, is going to be that as the memory prices go up, they're going to have to pass them on to consumers. Presumably, Apple will do that to try to maintain their gross margins. So I'd expect you're probably going to see a bit of a price increase for iPhones down the line. But of course, Apple's going to try to do as much as possible to minimize that. So that's what I'd expect. I'd expect that actually Apple's going to be able to ride this fine. And the question really is, if your iPhone is 10% more, are you going to buy as many? That's the big question, which we don't really know the answer to right now. And that's possibly why share price is a little bit weak today. But I'm still positive on the name. I think they're going to ride this out better than competitors.
Okay, so on the flip side, in terms of the latest earnings, Apple reported record sales, better than expected forecast, as you mentioned. What do you think is driving these results?
Yeah, so the iPhone 17 has just been phenomenal. Revenue is up about 23% year on year, I believe. All-time high revenue, all-time high market share also for iPhones. They did great in not just US, across the world, including and especially China, rebounded a lot. So I think a big reason for this is actually the lapping of the COVID cycle. So if you remember during COVID lockdown, 2020-21, there was a surge in people buying phones, particularly iPhones, and those phones are now about 4 or 5 years old, and so that's, I think, one of the biggest reasons for the uplift in prices. I think the company would like to say that the iPhone 17 was better than ever, but actually, I think it's mostly COVID cycle lapping itself, and looking forwards, I think that's probably going to continue for a while.
Very interesting. When we're talking about sales in China in particular were up for Apple. What do you think attributed to that? Was that also because of the iPhone 17?
Yeah, it's mostly iPhone 17 in China as well, and some of the older products. What happened in China is there was a bit of a subsidy program there that Apple benefited from, and they did not benefit from that last year. So they got a bump up from some of the subsidies in China. Plus, Huawei is a bit on the back foot at the moment due to their new operating system that customers aren't really fully in tune with yet. So Huawei is a bit on the back foot, so Apple benefits a bit from that as well.
It's hard to talk about any tech company and not talk about AI. So I'm wondering if Apple has said anything in these latest reports and these latest earnings about its progress with AI.
Yeah, so they did talk on the call about Apple Intelligence. They talked about Siri, the new version of Siri it's about 2 years late now, but I think there's a lot of expectations for that. It was confirmed in the press a couple weeks ago that Apple is working with Google Gemini models to improve Apple's own foundation models, and management, including Tim Cook, discussed a bit about that. They discussed that the collaboration with Google is to bring the best out of both Apple foundation models and leading Gemini models to provide what is an enhanced, better, more personal Siri and Apple Intelligence going forward. So they did not clarify exactly when that will be, but they did promise it will be this year.
And obviously, like, the iPhone is the big thing for Apple, right? And the iPhone 17, as you mentioned, but obviously Apple has a lot of other components that it sells. It did mention it was sluggish in demand for its wearables, like its Mac and accessories division. Is this something you think investors should be concerned about?
Not so much. I think it's really just related to the timing of launching of products, and iPhone is just dominating the press and dominating because the iPhone 17 cycle and the lapping of COVID, as I mentioned, and so all the other devices, they're chugging along pretty well. It's just compared to iPhone, they're paling in comparison because iPhone was up massively. Services also was pretty good, by the way. It was all-time high revenue for their services business as well.
Okay, that is all the time we have. So interesting to dig into those details. Mark Newman, Managing Director and Senior Analyst covering technology hardware at Bernstein. Appreciate your time. Thank you.
Thanks very much.
Coming up, hot picks in global stocks. Our next guest says these 3 stocks will benefit from long-term structural changes taking place across Europe and the U.S. Stay with us. Welcome back. Now it's time for hot picks in global stocks. Our next guest has a manufacturer and seller of electrical products as his top pick. He says Hubble is a play on the enormous hunger for power driven by AI data centers and the expansion of the power grid. So joining us now is Jens Pierce, CIO and portfolio manager at Mirova US. It's good to have you join us. Thanks so much.
Thank you, Lindsay.
Okay, let's start with Hubble then. Tell us a little more about it and why you like it.
Sure. Well, Hubble is an American company, about 26 billion in market cap, I believe. It's almost a pure play on electrical components for utilities. As you stated, there's an enormous hunger for power these days. originally driven in the last couple of years more by electrification of our grid with more electric cars, renewables, etc. But more recently as well with data center expansion, deglobalization as well as helping here as many countries, including in Europe, for instance, Germany, but certainly the US here as well, are really bringing and industries back home, need to expand capacity, and for each new factory, obviously you need power, you need water. And for that as well, we need to upgrade the grid. We're also dealing with, as we know now, like very severe winters with more blackouts, more storms, and the quality of the grid also needs to be upgraded. And regulators and utilities are really open for that. So Hubbell is a pure play on the U.S. market. A market that is very well protected. European players that want to get in here have more difficulties because utilities tend to kind of choose the players they historically have worked with as well. So Hubbell is very well positioned for that. So again, both the AI space and the expanded industrialization of the US are really, really important drivers here.
Mm-hmm. You say also, like you touched on this, but Hubbell is driven by the reindustrialization of the U.S. and Europe. Can you expand on that? Like, what do you mean by that?
Sure. Well, with deglobalization, and specifically, like President Trump here, for instance, is really big into bringing industries back here, or even like incentivizing foreign companies to produce for the U.S. market in the U.S. as well. So we really see an expansion in multiple industries, from traditional industries to even the pharmaceutical sector. New factories need to be built over here. AI obviously as well, like with the new data centers. But new factories all need water, all need power. That leads to more power generation. So historically, we've seen for the last 20 years almost no growth in new generation, and we expect that to accelerate to something between 2 and 5% annually for the next at least 1 or 2 decades right now. So we need to have a huge expansion of the grid to accommodate that. So there's extra demand for power. Not only because of AI and electrification, but also because more industries are coming back to the US, for instance, as well, and are expanding their capacity with excess demand or extra demand for power, for instance.
Okay, let's move on to your next pick. Vertiv, I hope I'm saying it right. What do you like about this stock?
Yeah, you're saying it right.
Okay.
So no, Vertiv is, I think, a safe play on AI and data centers. You see it on this graph as well. It's already had a good run. But Vertiv is basically, it's almost a pure play. They have 80% exposure to data centers, and they offer products for both power and cooling. And specifically, the cooling element is super interesting because they do air cooling and also liquid cooling as well, which I think is the future for cooling in data centers. What's also impressive about them is that they really have the full range of clients. So they basically have every hyperscaler as a client as well. So whoever is increasing capex, others may be decreasing capex, they will always be involved. They're also involved with the design, for instance, of the GPUs and the ASICs and the chips, all involved for the data centers as well. So from a very early point in the process for capex expansion, they're really already let's say, working with those, with the NVIDIAs of this world, with the Broadcoms of this world, to in the design of their products as well, to have the appropriate cooling and power products there as well. So they have, a very long investment cycle ahead of them. They have a very visible order book as well, and growth, is certainly expected to accelerate from here.
And your last pick, Boston Scientific. Why do you like this one, and why did you choose it?
Yeah, well, it's not so much of an industrial play, this one. We know with, say, global trends like aging population and longevity, heart problems, cardiovascular problems are becoming more prevalent. About 1 out of 10 people globally is suffering from heart rhythm issues. They're a market leader in devices that deal with that. They've also made a recent acquisition in the neurovascular space that helps, with treatment and prevention of strokes as well. And again, like as our population gets older and we live longer, the treatment of those will become a lot more important going forward. Very specifically for them as well, like in March, we expect an important trial to be published, where we expect very, very positive results. that their treatment, will be to prevent clotting, basically, or to deal with blood clotting in the heart. Very likely will be a preferred option going forward. So that should actually lead to an accelerated growth driver and expansion of their overall addressable market.
Interesting stuff. Okay, that's all the time we have today for Hot Picks. Jens, appreciate you joining us. Thanks so much.
Thank you very much. Bye.
There's Jens Pierce, CIO and Portfolio Manager at Morova US. Coming up, we will do one final check on the markets as gold weighs on the TSX today, and we'll tell you about a salt shortage caused by the recent blasts of winter weather. Stay with us. An early and relentless winter is depleting road salt supplies across Canada, raising concerns about safety and supply shortages. CTV's Adrian Gabriel has more in this report.
Goderich, Ontario is home to the world's largest underground salt mine, and yet the province is grappling with a short supply.
If we get into a bad ice storm, we could easily run out of salt.
An essential commodity during the harsh Canadian winter, reserves are running low across multiple Ontario municipalities. The city of Pickering says its dwindling salt stock must be used carefully to help ensure supply lasts through the remainder of the winter.
The road salt shortage means that multiple private companies and municipalities are having to do this with their limited inventory. Take their road salt and mix it with sand to try and stretch out their supply.
Dave Giroux's large contracting company is facing the same issue as Ontario's municipalities.
What is your fear?
That we're going to run out of salt. We service hospitals, we service government buildings, we service airports. So we have contracts that have high liability.
Giroux believes we're experiencing supply chain issues, not a shortage.
It does seem odd that we have the biggest salt mine in the world and we can't get salt here.
Distributors are having to send trucks to the port in Montreal, where long lines are reported to pick up salt brought in from Egypt and Morocco. In Goderich this week, more than 100 empty trucks line the roads outside of the mine that has the capacity to produce 9 million tons of salt per year. It's owned by Compass Minerals, an American company, and large lake freighters are shipping Canadian salt from the mine to the United States, all while there's a reported shortage in Ontario.
I wish the government would intervene.
Good morning, everyone.
CTV News reached out to Ontario's Premier, whose office didn't respond by our deadline. A statement from Compass Minerals in part reads, "We remain committed to serving all our valued customers in Ontario and all markets that we serve."
Some commercial distributors believe that the supply chain issues being experienced this winter are so bad, they're forecasting a continued shortage into next year. Adrian Gabriel, CTV News, Bradford, Ontario.
And we'll take a quick check at the markets before we wrap up here. We'll take a look at how the TSX is doing today. We know materials, the big drag on the index today. You can see it's down more than 5%, more than 2% at the moment. It's mostly because gold companies are coming under pressure. And obviously, we're watching the price of gold going down today. But here's a look at some of the biggest losers on the TSX when it comes to gold stocks. Aya Gold and Silver down more than 10% at the moment. Centerra Gold down almost 9%. New Gold down also almost 9%. And if we take a look at the reason why gold companies are sinking, with a look at gold prices today, they are down after seeing such a record run over the last 2 weeks. This is the intraday trading so far. You can see gold prices trending down more than 5% at the moment. If we take a look at the last week for the price of gold, it's been a bit of a roller coaster, reaching some real record highs, even just yesterday. And then today, that price of gold dropping, of course, partially because of this announcement coming out of the White House, where Donald Trump has made his next, what would be his next pick for the Fed chair. So that's potentially affecting the price of gold and silver today. And now if we move on to the U.S. markets before we wrap up here, holding up better than the TSX, but the S&P 500, Dow Jones, and the NASDAQ still trading down today. Investors feeling a little uncertain after what's been so far a bit of an uncertain week. One notable mover is Verizon. It posted big wireless gains. It plans $25 billion in share buybacks. Deckers Outdoor rises on higher fiscal year net sales forecast. So we're watching that stock as well today. It's up more than 15% at the moment. And that wraps up this edition of the Open Morning Markets. Is up next with Roger Peterson. Stay with us.